So welcome everyone to our monthly analyst call. Today's call is about what happened on crypto markets this summer. We're going to dive into the market crash that happened in August and what are the consequences of this crash on crypto markets overall, what we can expect next, specifically given the current state of liquidity on crypto markets. And finally, we're going to explore a bit what has been driving ETH's price dynamics lately, specifically since the ETH ETFs launch, because overall ETH as an asset has underperformed compared to other assets in crypto, and we're going to explore why. So for those that are new to Kaiko's webinars, Kaiko is a market data provider. We've been around since 2014, and we provide data. We do provide many types of data, including off-chain data, what we call market data, as well as blockchain data, which means DeFi and blockchain data. But we also provide quantitative analytics for spot and derivatives markets, for example, measuring risk, specifically for crypto markets. And we also provide regulated indices to support, for example, derivatives platforms. In addition to the data, we also have some products which address researchers' needs. As for example, our visualization platform called Data Plus, which leverages our price, volume, and liquidity data to make it available for researchers and for the media to leverage. And in addition to that, the research team who's presenting this webinar, so myself, Desi, and Adam, we provide every single week to our community some research. So we have weekly newsletters called the Data Debriefs, going over what happened on the markets the previous week and even like the day we release these newsletters. And we also have once every 2 weeks our data deep dives, which provide you a deep dive on a given topic. And finally, every quarter we produce some reports, which you can find in our website, covering what happened on crypto markets over the quarter. Finally, we do these webinars every single month, going over crypto insights and market trends, which we think really matter. Some latest Kaiko news and updates. So this week we're present at Token 2049. So if you're there, please reach out to us. We'll be happy to meet you. And 2 weeks ago, we have released our quarterly crypto exchange ranking. So this ranking is available on our website. It's available for free. Anyone can take a look at it, play with it. And it ranks more than 40 centralized exchanges based on several scores, including governance, business, liquidity, security, technology, and data quality. You can scan the QR code to discover the ranking and play with it. And in addition to that, every quarter we provide a report which comes with the ranking and basically provides you an analysis of some of exchanges' rankings and scores. So if you wish to know more about the exchanges, centralized exchanges trends, you can also download the full report. So now we will begin what we have prepared for today's webinar. And we actually asked you last week on social media, including LinkedIn and Twitter, what you would like to see on this webinar. And most of you have voted on altcoins markets. So Desi is going to present us the main altcoins chart that we have produced lately and basically explain to us what this shows.
So the chart we decided to show this month is Bitcoin dominance relative to the 50 altcoins by market cap. This is a chart we published yesterday in our newsletter and kind of summarizes what's happening in the market right now. We see that Bitcoin dominance has been rising pretty steadily, especially in the third quarter of the year, and it's currently at its highest level since February at around 65%. So one of the reasons for this is, of course, the fact that we are currently in a period of market uncertainty and traders typically rotate into Bitcoin from altcoins into Bitcoin, which is seen as a safe crypto bet. But this is not the only reason for Bitcoin outperformance, and we're going to dive deeper into the different reasons for this performance in the following minutes, starting with Anastasia, who's going to talk about ETFs.
Great. So yeah, first topic is we're going to explore ETH's price dynamics following the launch of ETH ETFs. So the launch of ETH ETFs happened late July, and it wasn't expected to lead to a price increase for ETH because everyone was expecting it to happen, and in a way, it was already priced by the market. However, when we look at the actual debut of these ETFs in terms of volume that has been registered on exchanges, these ETFs are listed in the United States. We actually can see that the volume at launch day was considerably lower than for Bitcoin ETFs. For ETH ETFs, we have less than $1 billion volume in dedicated exchanges, and for Bitcoin ETFs, we had back then more than $4 billion of trading volume at launch day, which is a considerable difference. However, this wasn't basically the reason why, at least that's not what the data suggests, why basically ETH's price actually dropped after this launch. When we look at ETH markets, not ETH ETFs, but ETH and the market's sentiment just after this launch, we actually can see that markets were very positive about this, and this metrics basically is the cumulative volume delta. It shows whether people are mostly buying or selling. When it's positive, it means that they're mostly buying on crypto spot exchanges, while when it's negative, they're mostly selling. And so here we can see that specifically on US exchanges, the sentiment was very positive after the ETF launch, and this for several days. However, this wasn't reflected by the price that since the launch of these ETFs has dropped by 30% until today. So something happened despite the market crash and rumors on jump trading's ETH ETFs, ETH positions that are being liquidated. So despite this, something needs to be unveiled to explain this drop in price, that and the fact that the price of ETH actually didn't recover as well as the price of Bitcoin, for example, since the market crash. At first, we can say specifically, given the data on launch day, that this drop is based on the lack of demand for ETH ETFs. However, when we look at the overall amount of ETH that is held by ETH ETFs issuers on chain, we can actually see that this amount has decreased overall, but this decrease was mainly due to grayscale. For all the other ETFs, this demand has been positive. This means that basically the ETHs under management for other ETFs increased over time since the launch until today, which we can see in this chart. When we look at the flows, excluding grayscale, we actually can see that the on-chain flows with respect to the wallets that hold the ETH that are backing ETH ETFs actually were net positive, which means that there was positive demand for these ETFs. However, it's indeed decreasing over time, and it's currently near zero, specifically since the market crash on August 5th. So the reason why ETH's price dropped isn't demand for ETH ETFs. It's neither people selling on markets, but it's something else. And this something else, according to the data, seems to be grayscale. And the fact that grayscale ETFs holders actually are exiting the fund in order to sell their ETHs that they just can redeem, since the ETH spot ETF issued by Grayscale has been approved. Because initially, this ETF was a closed-end trust that became a spot ETF. And so people who have bought shares of this called ETH so ETH ETF fund, for example, back in 2023, can now exit and sell their shares. So redeem first their ETH, not at a discount, but at the actual value of ETH. So they can benefit from the discount they have bought the shares at back in 2023, for example. And so they basically exit with their ETH and they naturally sell their ETH on the markets to make profit out of these positions. And the amounts are pretty big. So we're talking here about $1.6 billion in ETH that exited Grayscale's fund. And so this represents a massive selling pressure on ETH markets. And it lasts over time. This is the important thing. It's not just after the launch of ETH ETFs. So it's not just about here, but we can see that it gradually, so the amount of ETH held by Grayscale's ETH ETF on-chain actually decreases progressively. And this was also the case for Bitcoin, by the way. It lasted 4 months until Bitcoin actually takes over. And until we actually see a kind of stability in Grayscale's Bitcoin equivalent fund. To counter this, Grayscale actually came up with Grayscale's mini trust, which actually competes with other ETFs in a way that it provides them with very competitive fees. And so the problem is that, like this, as you can see in the data, the amounts managed by Grayscale's mini trust do not offset the massive exodus we have seen from the ETH fund, so the normal Grayscale ETH ETF. And so as long as this doesn't compensate the exits, we can expect to still have a constant selling pressure for the asset. When it comes to actually what happened next, as I showed you previously on the price chart, in addition to this selling pressure, which was structurally anticipated given the way the Grayscale fund works and the possibility it offers to its investors, we did had some ETH-specific events that have been driving the price down, in addition to the overall market crash that impacted all cryptocurrencies in August 5th. We also had jump trading rumors about them liquidating their ETH and staked ETH positions. So basically, kind of sell-off of ETH began on August 3rd, and ETH hasn't recovered since, given all these negative events that have impacted the asset. So based on that, Desi is now going to take over and explain to you basically what happened this summer on crypto markets, as well as the consequences of this summer sell-off.
Thanks, Anastasia. So I'm going to talk a bit about what happened in the market over the past few months. We had a couple of large sell-offs and a surge in volatility, which was largely driven by macro events. And so we can maybe move to the first chart. So here we have the 30-day historical volatility for Bitcoin and Ethereum over the past 4 years, basically since 2020. Highlighted in gray, we see September's. We know that historically August and September are a bad month for crypto assets and for risk assets in general, and seasonality really starts to be a bit more helpful in October. We see that volatility has been tending to increase in September. However, this year around, we have higher volatility in early September for both Ethereum and Bitcoin. The historical volatility was higher than what we had in Q1, which has never happened, or at least not happened since the beginning of 2020. And as I mentioned in the beginning, this volatility has been mostly driven by macro events and by central bank actions. We know that in the beginning of August, we had a huge risk of sell-off, which was driven by a growth scaring the United States and the Bank of Japan rising interest rates, which led to the unwinding of some leverage position related to the yen carry trade. The yen carry trade, for some context, is borrowing cheaply in yen and investing in US treasuries or high-yielding assets. So this trade became a lot less appealing after the Bank of Japan rose rates, and this led to a sell-off in risk assets. Now, looking at what's happening now, and this is the next chart. This is Bitcoin at the money implied volatility. It's a forward-looking measure which essentially shows the expectations of traders for the volatility of the underlying based on option prices. We have different expiries, and we see that even though volatility has been trending downwards as the market kind of stabilized after the August sell-off, it has increased pretty significantly for this week's expiry from below 50% or around 50% to 56%. And so the reason for this is, again, macro. We know that we have a lot of uncertainty around tomorrow's decision. The Fed is about to start cutting rates, but the amount of the cut is not clear. Actually, the market is very divided, and chances for a 50 basis point rate cut increased quite significantly on Friday, which led to this increased volatility and markets' expectations for short-term turbulence. So maybe we can move to the next chart, which shows trade volumes and essentially shows Bitcoin, actually crypto trade volumes on major exchanges over the past few years. I have annotated the sell-offs we had this year. We see that the August sell-off was pretty significant. It was one of the worst sell-offs in crypto history over the past few years. It's the second largest day by trade volume after March 5th, when Bitcoin hit an all-time high. And it is higher than what we had during the FTF collapse and the collapse of SVB. So something similar happened to derivative markets. Here we have Bitcoin open interest on the left and the change in open interest on the right. We see that the August sell-off was a big deleveraging event. We had the largest daily drop in open interest since August of 2023. Open interest actually declined by around 2 billion in a day and remained below what we had in early August. When we look at funding rates, which are not charted here, but when we look at funding rates, we see that sentiment has shifted quite significantly. Funding rates have been negative to neutral since August 5th, which means that we are currently in a very risk-averse environment with low bullish demand, and this is one of the reasons why we see a rotation into Bitcoin. Next, we look at the CVD, which, as Anastasia mentioned, is an indicator of buying and selling. We calculate it as the difference between buy and sell volumes. Whenever it's below zero, it means that traders are buying, and whenever it's above zero, it means that traders, it's the other way around. Traders are buying when it's positive and selling when it's negative. So here, this is the period during the sell-off, so between August 4th and 6th for Bitcoin. We see a very interesting trend. We see that actually on US exchanges, the CVD was positive during the sell-off. It was negative on offshore exchanges and on Korean exchanges, which essentially means that traders were buying the dip or rotating into Bitcoin during the sell-off. This did not happen for altcoins, and the next chart shows the same indicator, so the same metric, the CVD for the top 5 altcoins by market cap. We have different exchanges. We essentially see that altcoins did sell off on most exchanges and did not have this increased demand. One exception is Bybit, and we have it was mainly driven by one altcoin, which is Solana. But overall, altcoins didn't see the same enthusiasm as Bitcoin. So looking at this from another angle, and this is the next chart, it shows the cumulative trade volumes for crypto assets between January and August. We see that despite the surge in volatility we had over the past few months, volumes are not that high. Actually, 2024 still lags a bit behind 2022 and 2021 in terms of trade volumes. But when we look at Bitcoin specifically, and this is the next chart, it's the same chart which shows cumulative volumes for January, August. But for Bitcoin, we see that 2024 is the second best year, even though we have a large gap between 2024 and 2021. And one of the reasons for this is, of course, the current risk aversion, but also Bitcoin benefiting from regulatory clarity relative to altcoins. We know that its status as an investable asset has improved after the approval of spot ETFs, and this has impacted altcoins as well. So one of the best ways to see how regulation is actually impacting altcoins is to look at listings. We know that exchanges have been listing quite aggressively during the previous bull run. This time around, it's a bit different, and this is the next chart. It shows the change in the number of active listed trading pairs by exchange. We assume that whenever this number is increasing, it means that exchanges are listing new assets, and whenever it is decreasing, they are either delisting or they are less trading pairs, active trading pairs on exchanges. And what we see is that basically the major exchanges such as Binance, OKX have seen a decline in the number of active listed pairs this year, which is related to regulation, to them becoming more compliant. And other exchanges such as Mexi, Bybit, which are a bit less regulated, are seeing a very strong increase in the number of new trading pairs. So with this, I'm going to give the floor to Adam, who is going to talk a bit about how liquidity has moved during the recent sell-off.
Thanks, Desi. Yeah, I'm going to dive into liquidity and kind of current market structure, where we're going kind of heading into the end of the year and early 2025. So this first chart touches on our recent research report from the end of August, where we looked at liquidating large holdings in kind of inspired a little bit by the Mt. Gox liquidations, the German government selling their Bitcoin holdings. We just said we want to look at, what can the market handle, and what happens if this continues. So we looked at Bitcoin's 1% market depth, which you can see in the chart here. There was a huge sell-off in November, huge drop-off in November 2022 when the FTX bankruptcy occurred, and Bitcoin's kind of liquidity stayed 1% liquidity stayed below there for much of the last 2 years. It kind of increased intermittently in 2023 when there was some positive news around kind of Bitcoin ETFs with BlackRock and Fidelity filing, but it was largely stagnant this time last year. And the Bitcoin ETF launch in January really kind of pumped it up and kind of helped it recover towards kind of levels that we last saw pre-FTX collapse. And the August crash here is also annotated because you can see that liquidity dropped off very sharply, but actually bounced back quite well. And we'll get into that in a couple of charts. The next chart, though, also shows similar timeline: liquidity, FTX bankruptcy, and August crash, but it's for Ethereum and Sol. I thought this is interesting to look. Ethereum's actually struggled to kind of get back to where it was pre-FTX collapse, whereas Solana has already eclipsed its liquidity, kind of 1% liquidity level pre-FTX collapse, which is quite interesting because a lot of Solana's fortunes were tied to FTX due to, FTX co-founder Sam Bankman-Fried's sort of affinity with the token and the blockchain. And I should clarify as well, we kind of 1% market depth we think is a good liquidity measure. We basically sum all the bid and ask volume 1% of the current market price to show kind of volume at stake, basically. So that's one of our main liquidity measures that we use. And the reason I'm starting off with liquidity in these measures is because I think it's useful to see that the market has recovered and there's a lot of prices have moved sideways, but the liquidity is improving, which means that that like Solana and Bitcoin and Ethereum, they can all handle these kind of shocks better. And I think that's well evidenced in the next chart when we look at the August crash. So if Bitcoin's 1% market depth over the weekend of the August crash plunged pretty fast, and that has several reasons. Less traders on the weekend now. Also, just it was a very dramatic crash, as Desi said, one of the biggest sell-offs kind of ever in Bitcoin. But what was interesting is that 1% market depth bounced back quite well. It was quite durable, I guess, or elastic. It kind of sprung back, and it shows the kind of evidences the recovery of Bitcoin's liquidity over the last 2 years since the FTX collapse. What's behind that recovery and what's driving it is in the next chart. As we can see, a lot of the liquidity is recovered on US exchanges. So for US exchanges, I take Coinbase, Bullish, Gemini, Kraken, anything with kind of US dollar functionality. And then offshore exchanges are Binance's, HTX, OKX, and others that don't have the US dollar functionality, or most trading pairs rely on USDT. So the one constant with most of these US exchanges, Coinbase, Kraken, Gemini, is that they're included on ETF benchmark fixing rates, and that ETF market makers and authorized participants will be active on there. So this is one of the biggest things that's kind of driven the recovery and helped US exchanges outpace offshore exchanges. If we go to the next chart here, we can see that Bitcoin ETFs had a sort of instant impact at the start of the year. This is from a research report we did in July on the sort of market structure impact of ETFs. We can see the Kraken's 1% daily change in market depth was much higher in the first quarter versus the third quarter of 2024. Across the board, it was this way. And then if we go to the next chart again, we can see that this actually if we drill down into the hourly trade volume, so we look at the weekdays only, when are people trading, when is the volume coming in? So we can see that this is mainly happening during US trading hours, with an uptick towards the end of the US trading day between 3 and 4 p.m. when ETFs are usually fixing their benchmark rate. And so we can conclude that, volumes are coalescing around US trading hours because ETFs have kind of institutionalized crypto markets, and this kind of helping kind of keep liquidity consistent and adding kind of an extra layer of kind of liquidity throughout the trading day, which is beneficial to Bitcoin going forward, because without that kind of institutional input, then prices aren't kind of supported to the upside as well. So if we go to the next chart, we can see that there has been some selling pressure over the summer, and we covered it in our recent report, and where that might keep on coming from going forward. Mt. Gox obviously has just over 46,000 Bitcoin left to distribute to creditors, and I believe they plan on doing that by the end of the first quarter of 2025. There's a few other potential sellers. Obviously, the UK government owns around 61,000 Bitcoin. There is some contention there about whether they could or couldn't sell that. It's kind of spurred some headlines since the new government took over in the summer. Would they sell it to fund spending or what? But I think it's unlikely that they sell, but it's a government selling. We've seen it over the summer with the US and with Germany, so it's there. China and the US obviously own the most Bitcoin. The US has plans to sell more and will continue to. Obviously, the presidential elections could have an impact on that, as some of the candidates have suggested, holding on to this Bitcoin and doing more with it. So that will be something to watch going forward. And I would also, including Tesla on this, because they haven't done anything with their Bitcoin in over 8 quarters now, over 2 years, but they did sell in the summer of 2021. And if there were expenses to meet, the Bitcoin poses a valuable asset that they could use to fund other operational expenses. And then finally, the introduction of ETFs and Bitcoin ETFs and ETH ETFs that Anastasia touched on. I think we've already seen kind of signs that asset managers aren't going to stop there. Grayscale have debuted a closed-end trust for XRP, which will work similarly to what ETH and GBTC were before they converted. So obviously these aren't the perfect product that Grayscale want. They've done this before, and they've wanted to convert them into ETFs. But it does expand the universe of investable products for XRP and for other crypto assets, and that will only aid institutionalization and help more firms be comfortable investing in the space if there's products that they're used to already. There was also a Solana ETF application from Van Eck and 21 shares in the US. These have kind of been shelved for now, I believe. I don't think that much would happen on them until there's a new regime in place in the US following the election in November. But we've already seen the first Solana-based ETF approved in Brazil, which led the way with Bitcoin as well, with launching spot Bitcoin ETFs, I think, in 2021. We've written about that as well before. So there's, all signs suggest that there's going to be more of these assets, more of these kind of wrappers coming. And well, what we've seen with Bitcoin, we can, likely see if these products are approved in the future, that liquidity will improve, and it just opens it up to a wider. So it expands the investable universe for the asset. So that's all I have on liquidity. So I think we'll turn over to a Q&A session now. Right, Anastasia?
Yeah, exactly. Thank you both for this very interesting analysis. I don't see yet any questions, but We'll give you some minutes if you have any questions to write them down so we can answer them. Whether it's on these topics we have touched on today or on any other topics that you have read on Kaika's research in the past few weeks. Okay, we have a first question from Daniel. So the question is, were there the same patterns apparent on DEXs during the summer sell-off? Adam or Desi, do you know?
I think I was checking out DEXs recently. I think volumes were kind of lower on DEXs over the summer. There wasn't as much as far as I recall. I think Base and a few others had a bit of a boon in kind of March and April when the meme coin mania kind of was taking off. But no, I think it was a little different over the summer.
Maybe to add something to that question, which I think can be relevant, can you tell us a bit, Adam? So what we saw on DEX is basically the major event that impacted DEXs was this CFTC. So the CFTC going after Uniswap. What happened on DEXs just after that?
I think Desi was there. You cover that.
Desi?
Yes, we had a spike in Uniswap trade volumes right after the CFTC announcement, but overall the market reaction was pretty muted, which shows that traders didn't think it's a very significant market event. However, during the sell-off, to go back to the question, we did have some liquidations on Aave in particular, which led to a lower demand for borrowing after the sell-off, and this is related to the fact that actually traders were de-risking and switching to a risk-off mode. This is very, very clear when we look at derivative markets.
Great. So Daniel, I hope this answers your question. We have a few other questions. So one from Christina. So this one is for Adam. Why do you think Ethereum hasn't recovered from pre-FTX levels in terms of market depth / liquidity?
Yeah, it's a very good question. I think Bitcoin was benefited from the ETF, obviously, and the kind of hype around that last year. And Ethereum has sort of lagged it the whole time and hasn't had its own idiosyncratic drivers that I can see that will benefit the price. Solana, obviously, it's benefit the price and bring more traders in, so Solana obviously had that at the start of the year. With the big meme coins, with kind of airdrop farming on chain, everything, Solana was sort of the hot button blockchain and token, so it helped it recover quicker. Ethereum hasn't had that sort of thing. I feel the upgrades have gone smoothly, everything's going well, and they're shipping kind of impressive fixes and moving on their roadmap, but I just don't think that's moving the market at the moment for people. And you can do things cheaper on Solana and it's quicker. So the narrative just isn't there right now for Ethereum, and as you showed yourself, there's a lot weighing on it headwinds-wise.
Thank you, Adam. Anything to add, Desi, on this one? No.
About the Bitcoin liquidity recovering, but not Ethereum, I think one of the reasons is probably related to regulation and the fact that we have less clear regulation when it comes to altcoins in general, not only Ethereum, but Bitcoin has definitely benefited from this and not altcoins, which means that market makers are just weighting the risks and preferring to gain exposure to Bitcoin.
Great. So another question from Catherine. So why did Grayscale even try to convert their GBTC trust fund to ETF, knowing that there will be a lot of exodus from their fund? Adam, do you have maybe an opinion?
Yeah, so I think the big thing with the GBTC trust was it was broken in the form that it was. It was trading either at a massive premium or a massive discount because it was closed end. They couldn't create and redeem at the same time. So there was always going to be a supply and demand imbalance between the number of shares and the Bitcoin it held. And I think it was 2022 or 2021, the SEC stopped Grayscale from creating and redeeming at the same time. So they couldn't congruently create and redeem and destroy shares, which meant that it flipped from kind of trading near NAV to massive premium for a while. And then we saw the discount come in when it was trading at a massive discount, and investors couldn't get out. So a lot of people were stuck in the fund. And I think, put simply, it was the best kind of solution for Grayscale to fix that. I think Fir Tree Capital or another hedge fund were suing Grayscale. Other people were demanding that they, file to allow redemptions so people could exit the fund. The quickest route out for them was to convert to an ETF. They kept fees high, and because prices have gone up, they're getting a sort of bull market kind of benefit from that, in that they're still collecting 2% on, but I think it's around 15-16 billion in assets under management or whatever it's at right now. So even with that massive exodus of Bitcoin, the price has gone up, so they're still collecting 2 or 2.5%. I forget the fee exactly, but that accrues daily on the AUM. So while it might seem kind of like a crazy idea, it sorted out a lot of headaches for them with getting people out of the fund and letting people redeem shares and fixing that kind of net asset value.
Very interesting. Tessie, anything to add on this? Or we can maybe proceed. Okay, let's proceed on the next question by Simon. So are VC funds investing into infrastructure from what you have observed? I actually don't know, since we do not track VC's investments data-wise, but maybe Desi, I don't know, in terms of tokens related to infra projects, do you know?
I don't have data on this, no. We can look into this, but we haven't.
I've not seen this either in the flows. I've seen people talking about it online, but I haven't seen much of that, or wouldn't be confident enough to speak to it.
I see someone typing, so let's wait a bit for the next question. All right, so we had an interesting chart with BTC and ETH volatility, and the question is, have you seen changes to lead lag vol between the two?
Yes, the realized volatility in the beginning, we see that the gap between the two has declined, actually, in line with the overall decline in volatility for both Bitcoin and Ethereum. I think at some point, actually, Bitcoin had higher volatility than Ethereum, which hasn't happened often historically.
Interesting. By the way, for those that are interested in joining our next analyst call, we're going to talk about volatility, and more specifically implied volatility and general how to use this metric to assess crypto markets volatility. So yeah, please subscribe to our next webinar if you want to know more about volatility. Danielle, so from a cursory look, they appear somewhat co-integrated. Desi, do you have anything to comment on that?
Maybe we can go back to the chart to show.
Yeah. So can you just, was it on your section?
Yeah, I think it was the first chart on historical volatility. Yes, I mean, the gap between the two is definitely lower.
All right. I think we're done with questions. I don't see anyone writing anymore. I hope you enjoyed the webinar. I'm going to put here quickly the QR code for you to register already for next analyst call happening in October 8th. So we'll have a special guest, quantitative researcher and analyst, who's going to explain to us things around crypto volatility and what tools you can use to assess this specifically for crypto markets. So if you're interested, don't miss it. And thank you all for attending. Thank you.